trade the print. So let's start with some earnings basics. Revenue is the top of the funnel. It's how much money goes in the door, and it's also called sales. Net income is what's left over after all the bills are paid. You can also call it earnings or profits, and if it's negative, that's a loss. Earnings per share, or EPS, just slices the pie of profits into a per share amount. And then there's GAAP, or Generally Accepted Accounting Principles. It's the official rule book, and it's required by law. But companies often decide to keep a separate set of books adjusting for one-offs. That's called non-GAAP or adjusted. More on that later. Finally, free cash flow is king. It pays dividends, funds buybacks, keeps the lights on. Now, let's clear up some misconceptions that might be common. A beat means that the company exceeded analyst expectation, but that's not always bullish. Companies aren't required to issue future guidance, but if they do, it usually matters more than history. A GAAP loss reporting according to official SEC rules might sound bad, but if cash flows are getting better, the future might be getting brighter. And remember that non-GAAP or adjusted EPS can exclude things like stock compensation and one-offs. Always read the fine print, as many games can be played here. Finally, many companies have a fiscal year that's different from the calendar year. You'll soon hear some Q1, Q2, and Q4 results in October and November. Now, let's tackle some bullish and bearish signals that the pros are going to be watching out for. Bullish first. Like if a company beats on revenue and EPS with healthy margins, that means it's not just cost cutting. If it also guides future results above street expectation, that's a home run. But sometimes all investors want to hear is a confident tone. Nuance matters. And bulls also want positive and ideally increasing cash flows. Stock buyback announcements, they tend to broadcast strength. And the same principle applies for dividends, which are basically cash payments to shareholders. Also, are orders and backlogs turning up? That means demand is strong. Then we have the bearish side. A miss on sales or EPS plus a cut to future guidance, that's pretty negative, unless the street was expecting much worse. Then you have shrinking or compressing margins, which means the company isn't able to squeeze as much profit out. And if it's worse than its peers or competition, that's a big red flag. And we already talked about the games that companies play with non-GAAP or adjusted numbers. Is there a never-ending series of one-offs each quarter, or is management always blaming the weather, or a strong dollar, or the weak dollar? That's a pattern, not an excuse. And softening cash flow or inventories creeping higher, that's a canary. Now, here's how to trade the print, where the secret is discipline over market chasing. Remember that after-hours trading can be very thin. What does the market, where does it open on day one, and then how does it close relative to that open? If a market jumps higher on the open than that sells off all day, that can be a bearish tell. Then always know your time frame. Is it hours, days, months, years? Always address the dominant trend on your time frame. And remember, an uptrend is a higher high and higher low series, the classic stair step. When the step patterns change, your trend has changed. And finally, keep in mind that the big players with strong hands are not nimble and they have to play the long game, but they can cause short-term whipsaws to fake you out. Watch for breaks to the upside or the downside that are quickly reversed. Bottom line, when earnings season comes, do not chase the headlines. Keep a level head and be prepared, and always have a plan. Wall Street loves its jargon, and reading an analyst note on your favorite stock can be a major head scratcher. With earnings season kicking off right now, we're decoding Wall Street analysts speak on today's Stocks in Translation. And let's start with a quick definition of analyst report. It's a research note that lays out an outlook on a company over the next 12 months. It usually includes a rating and a price target on the stock, and it breaks down risks as well as assumptions. It will also highlight what's changed versus the last note and whether their estimates move up or down. An analyst might have a positive, negative, or neutral view on a stock, but you're going to see different ways of stating that opinion based on the point of view. Here, if they're writing from the standpoint of what to do with the stock, it might be as simple as buy, hold, or sell. Then they might write from the perspective of how much weight the stock should have in your portfolio. They'll say overweight for bullish, equal weight for neutral, or underweight for bearish. And sometimes they might take the view of how the stock is expected to perform versus a general market benchmark like the S&P 500 or the stock sector. So for a bullish opinion, they'll use the term outperform. For a neutral stance, it's market perform, and for bearish, it's underperform. And when they change their opinion or stance, they'll generally say upgrade if they got more bullish or simply less bearish, or downgrade if they got bearish or just less bullish. If they're starting to cover a stock from scratch or after a long pause, they will use the term initiate. Now let's take a beat and break down the stock's price target, or PT as they say. Think of it as a simple spreadsheet output. Dozens or even hundreds of numbers are going to go in and one comes out. It's not a promise, it changes when the inputs change. And most price targets are in a 12-month view unless the note says otherwise. And remember that they're not trying to time the market. This is big picture, long-term thinking. Many times they'll lay out a bull case and a bear case as well as their base case. They should tell you their confidence in these scenarios as well as a risk. And a wide range of possibilities, that simply highlights uncertainty. Always take note of their assumptions, whether it's margins, multiples, rates, or growth drivers. What are the dials that move the numbers? Now let's address some common misconceptions. Sticking with price targets, a new one doesn't necessarily mean they've got a brand new thesis. Read why they moved the target. And if the stock price hits that target, it is not necessarily a sell signal. Many times, an analyst will end up chasing the stock price. And for timing signals, the separate field of technical analysis, that can help you out there. And keep in mind that one analyst rating is just that, one viewpoint. For a broader perspective, we track the consensus opinion by taking the average or median of all the different street views. And neutral, it doesn't necessarily mean bad. Sometimes a stock is just fairly priced after a run. Now let's break down the bullish tells versus the bearish ones in those notes. On the bullish side, a raised estimate or higher price target with new facts is real fuel. Higher profit margins or new drivers of cash flow can be a quality upgrade. Cash is key, and it pays for buybacks, dividends, and debt. And how clear is the roadmap for the company? Are the factors that matter easily identified, along with milestones to note any progress? You want the ability to track specific things on a timeline. And on the bearish side, watch out when an analyst lowers its estimate for key numbers or moves key milestones into the future. That's saying less earnings or later, which usually deserves a lower price today. And if an analyst's thesis hinges on one-offs or hope, that's fragile. Hope is not a strategy, and fixes, they need evidence. And finally, if the analyst is signaling that some of the company's vital signs are deteriorating, like users, orders, or cash conversion, that means the health is slipping.